Good morning.
Good morning, Richard. How are you, sir?
I am glad to see you. I'm Richard Spears. You are?
John Spears, yes.
And we are here in the Tulsa World Headquarters in the Magic City.
Right.
To host yet again the Drilling and Production Outlook.
That's a great. Absolutely. Looking forward to it.
We have hundreds and hundreds and hundreds of subscribers all over the world, as we have for years. And in the olden days, we used to meet in person 4 times a year. Now we do this. One of the things I've noticed by doing things virtually now is, what would you say would be the average number of people who'd show up when we would meet in person?
80 to 100 down in Houston for this meeting.
And now we have, I'm going to look at the producer of our show, and we have how many people show up by the end of of an event. About 1,000 people are able to participate. Maybe they are not participating right immediately now because
Yes, right.
8 o'clock Central Time doesn't fit everybody's
No,
schedule.
right. Hardly fits mine. But the point being that this is a better way from a distribution standpoint, from a exposure standpoint. So when things open back up, as things open back up, I'm sure we'll probably continue on with something like this going forward. So
We're going to have everybody come here in the studio.
there you go.
Saves me I can sleep in my own bed, make you guys travel. But I was looking at the other thing I thought I would ask you, if you knew the number. Do you know how many people work for us?
Work for us?
Yeah, who we would pay during the course of a year. Which
Well,
is a different question. Because what category would I be in?
Well,
Would I
we
work
have
for-
we have 7 direct employees. We have another score that work for us on an
And how
retainer
many is a
basis.
score?
20.
So that's pretty good.
Yeah.
I counted 17.
Okay, good enough. Fair
And
enough.
and so that is so the 17 of us very much appreciate how many of our clients have held with us,
Yes.
especially during this crazy year. And one of the things we've noticed is that so many of our clients, so many of the people who we interact with, and by the way, we interact with as many as now 20,000 people in the course of a month.
In one way or another, yes.
So it's just
Yeah.
the crazy sort of numbers that have increased. But so many of our clients are those people. Actually, we have a lot of people who are on frac jobs who are fans.
Yes.
How it makes a bad day worse. But they work very independently now. They are. It's hard to be collaborative when you're not in the same room with people, and it's just tough to do. So one of the things that our firm is going to do here in the next month or two, something we're doing this spring, is we're going to open up the vault in our firm and allow people all over the world to have access to the very same data and the analytics that our own team, the 17 of us, use to do our jobs. Now, we've never done this before because we've been in business since 1965. We have developed a raft, we have a vault of...
There's a lot of stuff there. Yes.
There's a lot of stuff.
Yeah. So.
And we thought, well, let's try to make everybody in the energy industry
Sure.
a better market researcher.
There you go.
So what you'll be seeing over the next month or two is a rollout of our service. We're going to put it behind a paywall, so there is a fee, but it's essentially going to be priced at, a round of beers for all your friends in downtown Houston over the course of a month. It's going to be that sort of a price tag, but it'll give you all sorts of access to the things that we use when we build our special reports, which are hugely popular. For example, what if you could know everything that we know about Schlumberger or about Brigade Energy Services or about Expro?
Sure.
I think people would like
Yep,
to do
absolutely.
that. Or how about this? You're going to talk about our forecast of drilling activity that looks at countries and at basins. But what if they could have the forecast that we have for just Continental Resources in North Dakota about
Yes,
wells and pads and the spending for just Continental in North Dakota? And how about this? The preferred vendors that Continental uses
absolutely.
in
Right.
North
Yeah.
Dakota. So it'll be those sorts of things.
A lot more granular than what we've ever provided before. So looking forward to it. It's pretty exciting to gear up to do this kind of thing. So,
Our team uses it to build up our reports, but we want to make it available to you to build up your reports, and let's just make everybody smarter.
sure.
Or you could be just as dumb as we are.
No.
No, make everybody smarter.
Lake Wobegon. Everybody's above average. Yeah.
So we're about to roll the tape on John's presentation. Just before the program this morning, John recorded this presentation. It works better technically on our end for John to have done it already. So you'll hear John, it looks just like John, sits right there.
Go through this, and then at the end, we'll take questions. This format allows us to monitor questions as they come in and respond to them during the broadcast a little bit more easily. And then, of course, at the end, we'll take anything that we've not addressed already and wrap up. So that's what's about to happen.
Yeah, so if you're on our YouTube channel, and I believe everybody is, by the way, do yourself a favor, do us a favor, and if you haven't already subscribed to the Spears and Associates YouTube channel, click. You can do that. You'll know when content is coming your way. But there's a chat feature there as you watch this. Type the question in.
Right.
Like, for example, who's your tailor?
We'll get to all of them.
We'll get to each of those. John and I will be monitoring them
Sure,
real time. The rest of our staff kind of deployed around the country.
Yeah.
They'll be watching them as well. So if a question is appropriate to, for example, David Hutchison in Houston or Austin or wherever he is today, he'll answer, or David Ott, he'll answer wherever he might be. And so I think we're about ready to go.
I think we are. Let's do it.
All right, roll tape, Charlie.
Good morning and welcome to the March 2021 DPO workshop. We've updated all of our outlook and numbers for the drilling activity in the U.S. and around the world. And I want to go through our slide deck this morning to talk about what the conclusions and numbers are from our updated forecast. And then, as we mentioned before, I want to take questions at the end of the slide deck. So I'm looking forward to any and all questions that you might have at the end here. As we all know, it's a dynamic time in the marketplace. For those who were with us back in December, you know that when we met then, the concern was that the market, the oil market anyway, was likely to be oversupplied. We were looking at a $40 price and worries that it might go down from there because traders were thinking that OPEC Plus as a group was about to sort of overproduce and end up oversupplying the market and driving prices lower. And now, of course, this very week, we have seen the group meet once again and take a decision to continue to hold barrels off the marketplace. Now the concern is just the reverse. Instead of oversupplying the market sees OPEC's a difference when it comes to what the outlook is and expectations are regarding oil prices, and that's informed the outlook we have for drilling activity going forward. In particular for the U.S., we had been thinking again back in December that operators would in particular draw down their inventory of drilled but uncompleted wells as a way of holding production steady, that would be sort of their first choice for their capital spending programs. And then they would restart their drilling activity in order to sort of achieve constant production levels. Well, it turns out that operators here in the U.S. need to drill a lot more new wells rather than draw down drilled but uncompleted wells. And so what we'll see as we go through our slide deck is that our outlook for drilling activity here in the U.S. for 2021 is materially higher than what we had been talking about when we met in December. But the number of completed wells, the number of fracked and completed wells, is not that much, is greater, but it's not as much different from what we had been talking about in December. So the emphasis here in the U.S. has really been on the need to drill new wells in order to achieve some of the production targets that we think operators are most interested in. So with sort of that summary done up front, let's get into the numbers and talk about how we see things moving through the balance of this year. So we always like to talk about global oil supply and demand as starters to think about what the macro environment looks like. And the numbers that are now being expected for global markets are that demand will average around 97.7 million barrels a day this year, up just under 6%. Now, interestingly enough, there has been the estimates of global oil demand have actually been lowered a little bit in the last 3 months as some of the issues around the lockdowns and reinstituting constraints on travel and so forth that many nations put in place back in December and January have had an effect in terms of overall economic activity and oil consumption. So that's pulled down the demand numbers a little bit, but we're still looking at about a 6% growth rate over the from year to year, and of course much higher if we think about Q4 of 2020 to Q4 of 2021. On the production side, estimates are now that producers will end up producing, again themselves, a little bit over 97 million barrels a day, 97.3, a figure that's up about 3.3% from last year. So that's what the market overall looks like. OPEC Plus was meeting this week to decide what to do about production in the month of April. So back in December, the group took a decision to slightly increase output, but along with that decision, Saudi Arabia, of course, voluntarily cut its own production 1 million barrels a day come January, February, and March. And so the question at hand, as the group was meeting this week, was does that group then begin to increase output, and what does Saudi Arabia do about its own voluntary production cutbacks? And the expectation had been among traders was that the group would begin to put some more barrels back to the market, perhaps 500,000 barrels a day come April 1st, and sort of ease back into higher production levels. And so it was a great surprise when the group decided earlier today that it would instead hold production steady for at least a month and not make any changes. Great surprise to traders. They've immediately bid up the price of oil, and so we of course then will see this same drama play out again in a month's time, because the group will meet and then have to decide what to do for May. And then after May, there'll be similar decision points throughout the year as OPEC begins to or continues to wrestle with this decision about how much oil should it bring back into the market as the demand picture begins to unfold. So I think it's going to be a very unusual year from an oil price standpoint, because I think we'll see a lot of this uncertainty about how much will they not, will they bring too much back in, and so we're going to see this affect oil prices, I think, throughout the year. But certainly by the end of the year, there should be relatively even balance between demand and supply, with inventories pretty much back to normal. I think when I think about the demand outlook and what I worry most about, I think the biggest concerns, of course, are will the vaccines that are being distributed hold up and continue to prevent the transmission and hospitalizations associated with any new variants in COVID-19. Because clearly all these demand growth numbers that are forecast for this year and next are contingent upon an effective vaccine being widely available. So issues regarding how quickly vaccine gets distributed and its efficacy regarding the strains that are out there is, I think, key to the demand numbers. And so there's great efforts on the part of the medical folks around the world to try and solve those problems, but it is there's still a lot to be determined as to how that might play out. Given what we think, then, we know about demand, supply, and OPEC Plus's immediate decision, it appears that oil prices will continue to be supported at their current levels and perhaps even a bit higher, so both on the spot basis and in the futures market. So the thing we've noticed this year is that the futures price is what's called in backwardization. The earlier months are priced higher than the months at the end of the year, indicating that the market believes that the supply tightness is here in the first and second quarters of 2021, and that by the back half of the year we'll see fairly normal conditions exist in the marketplace. We've not tried to be too sensitive about the quarter-to-quarter changes in the marketplace. We think that oil prices, broadly speaking, for WTI will be around $60 a barrel for the last 3 quarters of this year, and thus average a little bit over $59 for the whole year, which is up a resounding 50% from where it was a year ago. Brent trades $3 to maybe $4 above WTI throughout the year. At least that's been its pattern in recent months. The wild card in all of this, I think, continues to be Iran and what to do about Iranian levels of production. Of course, right now Iran produces around 1.9 million barrels a day, about half its production capacity. The other half of its oil is held off the market due to sanctions that the U.S. has put in place under the Trump administration about the disputes around the nuclear agreement that got negotiated back in, I think, 2015. So the question, of course, then is, under Biden, will those sanctions remain in place? And when might they come off, and how fast, and to what extent, and so forth? So right now, it appears that Iranian oil will continue to stay off the market, and so that underlies this $60-ish price estimate going forward. But I would point out that if in fact the Iranians can produce this almost 2 million barrels a day of production that they've got shut in right now, that represents 1 to almost 2 years worth of incremental growth in global oil demand. So should that source of supply suddenly come back on the marketplace, it would materially affect the outlook for oil prices, because there would be the markets would see that as being in a lot looser condition than what it is right now with OPEC sideline, or with Iran sidelined anyway. The other thing too is that beyond 2021, oil demand is expected to continue to grow at rates between 1% and 2% per year. So returning to its long-term growth rate, long-term being, say, the average growth rate over the past 10 years or so. That kind of growth seems to be, most people seem to be fairly comfortable with it for at least the next 5 years. Beyond 2025, of course, there's a great deal of divergence about estimates of where oil consumption might be. But anyway, for the next several years, it does appear that the market will continue to grow as it recovers from the effects of the pandemic, and as economies begin to recover. Given this estimate of where we think oil prices are, what does this mean in terms of U.S. crude oil production? And here is our estimate of that. We broadly see the U.S. operators achieving what they have, many of them have said they want to do, which is to hold their production in 2021 at or very near the level that they exited 2020 at. And what that means for the U.S. as a whole is about 11 million barrels a day of production on average this year, down slightly from the average of last year, but fairly constant going forward. You know, it's interesting to me that that the oil markets have that oil prices have risen when OPEC says it's not holding. When OPEC has said it would continue to hold oil off the marketplace. If we think back to 2017, 18, and 19 anyway, the oil markets saw a continuing increase in U.S. oil output, and pretty much could count on the U.S. delivering 1 million or more barrels a day of incremental oil production to the market year over year. So that took a lot of pressure off off oil traders, because they saw the market as being well supplied. OPEC could decide to hold barrels off the market, and that didn't drive prices up, because there was all this American shale oil that was continuing to enter the marketplace. Now we see the effect of the U.S. production running flat, and in a market when OPEC and OPEC Plus can control its own production, they have a significant ability to impact the price of oil, don't they? Because again, think about it. In this past week, the discussion was around: does OPEC Plus increase its output by 500,000 barrels a day? That would be about not quite a 2% increase in their output from what it is right now. They decided to keep that 2% increase off the market, and what we've seen is oil prices go up by 10%. So So I think there's a great deal of incentive on the part of OPEC Plus at this stage in the market when U.S. production is running pretty flat and really not in a position to grow much over the course of this year anyway, that if they can continue to maintain production discipline, that they have some ability to materially increase prices. And so certainly those folks who talk about oil prices spiking into the 70s have a strong argument, I believe, because I think the wild card, the issue in that place is going to be how much production discipline does OPEC Plus continue to exert going forward. So turning our attention to gas for a little bit, here in the U.S. anyway, the gas market is expected, gas consumption in the U.S. is expected to fall slightly this year. Notwithstanding the fact that we had, of course, some extremely cold weather in Texas and elsewhere, which have materially increased the demand for gas, at least on a short term, in February. But overall, the gas use in the U.S. is expected to be down a little bit, and that's entirely due to a reduction in demand for gas in the U.S. power sector. Higher priced gas, which we'll talk about in a second, will shift some of the demand to coal. And of course, there's this ongoing move to renewables in the power market. And so all that is going to end up meaning less gas consumption in the power sector in 2021. And while there'll be growth in demand in the residential and commercial markets and ongoing growth in the industrial sector, that growth there won't be enough to offset the loss of market in the power sector. So overall gas use in the U.S. is expected to be slightly down, to the tune of 1% to 2% this year. Now, on the good news side is that gas exports are expected to rise substantially this year. I think the most recent numbers talk about something on the order of an 18 to 20% increase in U.S. gas exports in 2021. So the gas export side of the house is shaping up to look pretty good, and expected to grow going forward. So, in fact, the longer term look at the U.S. gas picture that we've taken a look at in recent weeks suggests to us that if we look over the next 10 years or so, that here in the U.S. anyway, exports probably represent over 95% of the incremental growth in gas demand in the U.S. So there's very little net use in gas domestically, but continued growth in gas exports going forward. And so any growth on the production side will largely depend upon the health of the gas export market, particularly LNG. So in the coming year anyway, gas production looks to be, again, fairly flat. The specific numbers would say that gas production will average 90.5 billion cubic feet a day this year, and that's down less than 1% from last year. Pretty steady over the course of the year. What we've seen on a regional basis is gas production in some of the smaller gas plays, like the Anadarko, like the old Barnett Shale, Fayetteville Shale, and so forth. Those gas in those areas production is coming down. That's being offset by growth in production in the Marcellus and the Haynesville shales. And so the wild card then becomes what's happening with regard to associated gas production from oil plays out in the Permian and up in the Bakken and so forth. And again, with oil production largely steady, or expected to be largely steady over the course of this year, then associated gas production is expected to be little changed over the balance of 2021. And so that just leaves the gas production side of the story fairly well, fairly flat as best we can see it. So with that in mind, our estimate for gas prices then is that they'll be up substantially from last year. Our average for 2021 now looks to be somewhere above $3 per million BTUs, $3.10. specifically for the year, and that's up 55% from right at a $2 price for gas in 2020. Contributing, well, so, again, production and demand, little changed over the course of the year. Why the big swing in prices? Well, part of that's due to the fact that gas inventories are expected to be lower this year than last. Part of that, thank heavens, that's one of the good effects, I suppose, for the industry of the very cold weather that we saw across the country back in February. Was there was a lot of gas use, tremendous amount of gas pulled out of storage, and that will mean that come the end of the winter season, we'll probably be looking at gas inventory numbers that are 10 to 15% lower than what they were a year ago. So the market during the refill season, during the summer and fall months, is expected to be pretty strong, and that's going to contribute to these higher gas prices over the balance of this year. Now, again, longer term, as we think about gas prices after 2021, we don't have a lot of change in our estimate of where those will go. And again, that's because if we see higher oil prices, that's going to, rising oil prices will encourage more drilling activity, and the associated gas production should be enough to supply the increased consumption and demand for gas. So higher oil prices will certainly cap gas prices because of the effect of associated gas production here in the U.S. from these tight oil plays. So it's a better market, better price outlook for gas for this year, but we don't see that kind of a trend extending in a strong fashion beyond 2021, based on what we think we know today about where demand and supply and exports are going. So now, in the course of trying to forecast drilling activity here in the U.S. anyway, we've always said, and everybody understands, that it's important to know where commodity prices are going. But these days, that's no longer enough because, again, the operators here in the U.S. and around the world are increasingly facing a difficulty in accessing external sources of capital. So largely shut out of raising funds either through equity sales or by borrowing, either in public markets or even through banks anymore. So what that means is that cash flow from operations is going to be key to funding the capital spending plans of operators going forward. So we need to better understand what cash flow from operators looks like so that we can begin to make a decision about where reinvestment rates and where capital spending is going to go. In addition to understanding what's happening to cash flow from operations, we need to understand what's happening to reinvestment rates, because from a capital spending standpoint, those dollars to drill are increasingly going to compete with operators' desires to deleverage their balance sheets, so retiring debt, to increase payouts to shareholders, either in the form of dividends or stock buybacks. And the other new wrinkle with regard to capital spending plans anyway, is how much money is going to be directed toward capital spending to reduce the company's carbon footprint. So we're beginning to see more efforts made, and significant dollars being spent to that end. And so there's a lot of competition. The drilling program has to compete much more seriously this year and going forward because of these issues around access to external sources of capital, as well as increased competition for the use of the available dollars. So we have gathered information on about 30 publicly traded U.S. oil companies and tried to develop then these financial profiles to help us inform our decision about drilling activity going forward. And so we've also got a similar exercise set up and in place regarding international oil companies, regarding midstream operators, the pipeline companies of the world, as well as the oilfield service sector. But for the purposes of looking at drilling activity this year and next, the important market to look at, or the important set of data to look at, I think, is what we've pulled together with regard to U.S. oil companies. So these are companies that collectively drill about 35% or so of the wells that are drilled here in the U.S. and collectively spend about half the capital dollars for upstream activity. So it's not a full census of all operators, but it's a healthy sample of companies, and I think gives us a better sense of some of these questions regarding capital availability. So the slide you're looking at here is what the quarterly revenues are for this set of companies going back to 2017 and what we project on a quarterly basis for this year. So quarterly revenues back in 2017 came in right at $35 billion a quarter. Those numbers went up to $45 billion a quarter in 2018. Oil prices rose, and as you can see the pattern since then. The dark numbers for 2020 are because those are actual figures based on reported financial results. The light green shades are our estimates of what those numbers will be quarter by quarter in 2021. And all these estimates that you'll see on this slide and the next few are based on this estimate of a $60 price for WTI in 2021. So using that $60 price and what we believe will be their production figures, we end up with this group of operators generating somewhere between $40 and $45 billion a quarter in terms of revenues throughout 2021. Now, we're using this $60 oil price. My guess would be that at the end of last year, when these same companies were budgeting their numbers for 2021, they were probably using something close to what was the futures price of oil and gas at that time. And again, futures price was very close to a $40 handle for most of 2021. And so if we were to rerun these figures using a $40 price, what that would mean is that these quarterly figures, for revenues anyway, would be in the $30 to $35 billion range rather than the $40 to $45 billion range each quarter. So that was probably useful to keep in mind that operators, at least when they were establishing their drilling budgets for this year, were assuming something that would represent a collective revenue figure of around $30 to $35 billion for the year, much below what we show on this particular graph. Well, one of the other financial things that's neat to look at is what is quarterly operating income for these companies? Where has it gone, and where is it going? And again, you see the same pattern from 2017 through the end of this year, 2021, on this chart. Of course, the second quarter of last year was horrific from the standpoint of oil prices trading below $30 most of the quarter. And so many of these companies, in fact, I think every single last one of them reported operating income losses in the second quarter. And collectively, those numbers added up to almost $10 billion. They improved in the third quarter, turned slightly positive in the fourth quarter, and in the throughout 2021, we think the numbers will end up somewhere in around a $4 billion per quarter operating income for this collective group of companies. Again, this is based on a $60 oil price. If we were, again, to run these numbers using a $40 oil price, the quarterly operating figures will be in the $1 to $2 billion range as best we can tell in 2021. So we've looked at revenues, we've looked at operating income. The other key thing, I believe, is to understand what's happening to cash flow from operations. So again, informative to understand what's happened there. where of course your attention is drawn to the fall off in cash flow from operations in the second quarter of last year, when it fell to a figure that was around $5 billion in the second quarter, but then recovered to a figure of around $12 billion in the fourth quarter of last year. And again, using the $60 oil price and what we think we understand about how cash flow from operations gets determined, I believe that this group of companies collectively is looking at CFO numbers that are in the $14 to $16 billion range across the course of 2021. Again, these are based on a $60 oil price. If we were using a $40 oil price, those quarterly CFO figures would stay in the $12 billion range, about where they were in the fourth quarter of last year. So gives you some sense of the impact of a higher oil price is having on what cash flow from operations is. So the reinvestment ratio, sometimes we around this shop here, we just call it the plowback ratio, but it's capital spending divided by cash flow from operations. And this is an informative chart, because if you look back to 2017, what we see is that this group of companies was outspending its cash flow from operations. It was tapping into external markets in order to fund its drilling programs to the tune of about 115% of CFO. Now, investors began to push back and demand higher profitability, were worried about cost of operation and so forth. And so even as early as 2018, the group companies we're looking at had begun to adjust how it was, or how much money it was directing toward drilling activity, and so cash flow from CapEx and this reinvestment ratio fell down to this sort of 85-86% rate in 2018 and 2019, and then the first quarter of 2020. And then, of course, the world fell apart. The denominator collapsed, and so the ratio rose sharply. And then as things began to normalize in the second half of last year, what we saw was capital spending falling pretty dramatically. And as cash flow from operations began to recover, that plowback ratio ended up sort of coming in close to around 50% in the fourth quarter of last year. And again, based on the $60 oil price and the attendant estimates of revenue, operating income, and cash flow from operation, we think that the reinvestment ratio will actually grow slightly going forward. It goes from about 50% in the first quarter of 2021 to a figure of that's just shy of 60% by the fourth quarter of this year. So a bit of an increase in the plowback ratio as time goes by, but not much of one, and certainly not even back to the levels that we saw back in 2018 and 2019. Again, because of the intent to use this cash flow to deleverage, to improve shareholder returns, and to pay for decarbonization efforts across the organization. So longer term, I think that something on the order of a reinvestment rate of around 70% is probably about where the industry and these companies are going to go. This would allow them to grow production somewhat, about 10% max, I think, but would allow for capital to be returned to debt holders and shareholders. This group of companies collectively has outstanding debt on the order of about $170 billion, if memory serves me correctly. That represents about 45% of their capital structure. So you begin to think about how much of a share debt should be in an oil company's balance sheet going forward, and 45% is probably way too high. I think numbers that are on the order of 30% or maybe even below are probably what would be considered ideal. So there's a substantial effort needed to retire debt in order to get to that kind of a capital structure, and I think that will be multi-year effort for companies to achieve that, along with efforts to improve dividends and so forth that are happening. So put all the numbers together. What does this mean, John, in terms of capital spending? And here's what our numbers would suggest. That capital spending, which had been running, again, from this group of companies on the order of $14 to $16 billion per quarter back in 17, 18, 19, in the first part of last year, and which had subsequently fallen to around somewhere around $6 billion a quarter, I think is going to recover. We'll end up growing as time goes by. I think it'll average around $8 billion a quarter or thereabouts over the course of the year, but with the fourth quarter end up being a little bit higher than the first quarter of this year. And the Q4 numbers at somewhere approaching $9 billion a quarter versus the $6 billion which was being spent back in the fourth quarter of last year. So that's a 50% increase in capital spending from Q4 to Q4. So a pretty substantial improvement in those numbers going forward. Now, what's interesting is I think that these kind of CapEx numbers, now that we've seen rig count actually, continue to grow as it has in the first quarter of this year, I think that these kind of capital spending numbers were what operators had been planning, even when they were using a $40 oil price for their budgeting purposes. And so let me slip back a slide and talk about what these reinvestment ratios would look like if we were using a $40 price. And when we do that, what you see is that by the fourth quarter of this year, that plowback would be around 70% or thereabouts. So again, the numbers you're looking at on this slide are based on a $60 oil price. But if we were using the same capital spending figures from the following slide, but putting them in the context of a $40 oil price environment and revenue and cash flow from operations and so forth, what that would basically mean is that operators were planning on a plowback rate of around 70% by the end of this year, which again, historically is well below what we've seen in recent years, but I think pretty close to what most operators would be comfortable with going forward. The other thing that I think all of this helps us better understand is the question that we have to ask ourselves is, will this kind of capital discipline that operators talk so much about these days, are they really going to follow through with that, or will they fall back into the old bad habits of anything prior to 2018, where if oil prices ended up higher than forecast and if cash flow was greater than forecast, that all those additional dollars, rather than being put back to debt or equity, was rather plowed back into new wells. So this year, I think, is a test of that discipline, because I think all these budget numbers, the capital spending programs and so forth that we were looking at were based on a $40 price, and certainly with oil at $60 or higher, operators right now are seeing a much greater cash flow than what they had been planning on. And so if they stick to the path that we think they're on, that would tell me that their capital spending discipline is probably a lesson that has been learned and they'll stay with. If we began to see rig count grow much higher than the track we think it was on, then I think we have to ask the question about really what kind of capital discipline does the industry have, or maybe it's just a question of individual operators. So anyway, we don't have to wait to see if the industry has learned its lesson and is going to behave differently, because right now is a real test of those intentions. So understanding what we have done with regard to estimates of capital spending and so forth, what does that mean in terms of where we think oil rig activity and so forth is headed this year? So here's our slide looking at quarter-to-quarter changes in rig count. When we put all the numbers together for the year as a whole, what we're looking at is an average rig count of 464 rigs, which will be up 7% from the 435 or so that it ended up averaging last year. Perhaps more impressive is the fact that the gain from year end to year end looks more like a 70% improvement in rig count. So we end up at the end of the year somewhere above 500 rigs, somewhere in the 520, 525 range. Memory serves me correct for the fourth quarter of 2021. So we're moving up and to the right. Again, this is because operators, we believe, are telling us that they need to drill new wells rather than just draw down drilled but uncompleted wells as a way of maintaining production going forward. Now, the other thing that I think is, folks then, some would say that, well, rigs aren't what we chase. We're really interested in wells. So what do those numbers look like? And here's a chart for that effect. Again, total numbers for the year as a whole would be slightly more than 12,000 new wells drilled and just under 165 million feet of hole, with, again, the numbers trending up strongly as the year goes by. I should point out that I think the new administration in Washington and its efforts to restrict drilling on public lands, and what I think then will also be increasing difficulties with regard to development of midstream assets, so pipelines and processing plants and so forth. I think all that means is that the drilling activity that we'll see this year and going forward will be very much infrastructure led. It will be, I think, tend to be close to in established areas where sufficient takeaway capacity, pipelines and so forth, processing and so forth is already there, and not so much in areas where a lot of new infrastructure needs to get built, because again, I think it's going to be very difficult, maybe not just from an administration standpoint, but just from the fact that the environmental community has worked hard to diminish how much new infrastructure can be built. So I think here in the U.S. will be infrastructure led in terms of where the drilling takes place. So Permian Basin looks pretty good. It's well supplied from pipeline standpoint. Established plays like the Haynesville on the gas side are in decent shape. The Marcellus, for now anyway, is doing well. So those are the kinds of, and then of course the Eagle Ford down in South Texas. All those are areas that are, from a gas standpoint, either near export markets, or from an oil standpoint, also near export markets and near petrochemical facilities and things like that. So I think we'll see I think that will be a theme in the areas where we see activity improve in the course of 2021. Now, as I'd said earlier, the big gains or the big revisions to our forecast are on the drilling side because of this emphasis on new wells needed to sustain production. What our frac forecast is also somewhat higher than what we had been using or talking about in December, but back then I think we had been talking about 8,000 or so frac jobs over the course of 2021, and now we're looking at 8,500 frac jobs over the course of 2021. So what we believe we're doing is swapping in the old forecast a fairly substantial portion of already drilled but uncompleted wells, and these wells will for the most part be wells that are being drilled this year and being completed this year. So the frac job count is moving up and to the right. It can be a smooth incline going forward, but as you can see, Q1 21 has been reduced, and that's again because we lost 2 to 3 weeks worth of frac activity thanks to the very cold weather in the middle parts of the U.S. In February. So that reduced frac spread count from about 160, 170 rigs down to I think about 40 as a low. And so while that number I think will come back to the 160, 170 level, all that takes time. And in the meantime, we've lost some frac job starts that we're tracking on this particular chart here. So it's a better story, but we have a bit of a recovery process to go through come in the first quarter of this year. Again, those folks who get and follow the frac spread counts we use a number of about 50 frac job starts per crew over the course of a year. So if frac crew count ends up averaging 170 crews in the course of 2021, and each of them are doing 50 wells per crew per year, then you get to 8,500 or so frac jobs in the course of this year. So our 8,500 frac jobs corresponds to a frac spread count of around 170 on average in 2021 for those who have access to and think in terms of frac spread count when they think about frac activity. So activity up, spending up. Not much change, however, we think in terms of the cost of getting wells drilled and completed. So we do a quarterly survey. You see the results in terms of quarterly price change in our cost index going back to the start of 2019, and the actual numbers end through the fourth quarter of last year, and estimates then what we think we'll see in the 4 quarters of this year. So as best we can tell right now, most cost categories for new wells are fairly well contained, even though we're seeing activity recover. There's still fairly low asset utilization among crews, rigs, frac crews, rigs, and so forth, and that's keeping a lid on prices. Pipe prices have been rising pretty sharply, and that's not because of anything intrinsically happening in the oil and gas industry, but rather in the broader steel industry. Scrap metal prices and hot rolled coils prices are going up, and that's adding to the price of steel products here used by the oil patch. So we do see a bit of price cost increases occurring in 2021, but not much. So it represents kind of an ideal time for many operators. They've got the cost side of things relatively well under control for now. The price of their commodity is going up, and so they're able to realize significant improvement in their profitability this year. So the wild card, or one of the things I think we'll be tracking closely, is looking at labor costs in the service sector. So hiring, we know, has picked up at the field level. As we tracked data through 2020, what you saw was that employment fell in the sector, but hours per work week rose as service companies wanted to add overtime hours, rather than hire new workers. But that trend toward shifting work to overtime rather than hiring has kind of gone as far as it goes. I mean, in the service sector, I think the average work week was approaching 48 hours at the most recent monthly data that I saw, and that's about as high as it can get. Then the service guys really do have to shift toward adding headcount in order to realize the opportunities for work that they're getting. So labor hiring is going to go up. Whether that translates or what comes with that is a higher rate per labor hour will be something we want to track, because that could provide a cost push element to the inflation story in the oil patch. We certainly haven't seen it yet, but that will be something that we want to stay aware of and pay attention to going forward. Talking about the Canada, because all the elements of what is affecting operations in the U.S. Apply to our neighbors north of the border, as we've said many times before. Activity in the first quarter of this year, rig count week to week, has been about 70% of what it was a year ago. So again, Q1 of 2020 was very strong because we had not yet begun to feel the full effect of the pandemic and its shutdowns and the impact on prices and so forth. So rig activity was very good a year ago, and the numbers for the first quarter of this year, I think, were the numbers for rigs running and the dollars being spent and so forth, was all conditioned upon assumptions of about a $40 oil price that were, is in effect back in the fourth quarter of last year. So our Canadian patch was the activity in Q1 has been really reflective of this $40 oil price environment that plans were being made in. And we won't begin to see the effect of a $60 price assumption on activity until we get well into the second half of this year. So we really don't begin to see quarter-to-quarter kind of improvements in a noticeable sense until the third and fourth quarters of 21. And what that means is that for us anyway, as we average it across the year, it looks like Canada will end up averaging around 86 active rigs this year, down 4% from what it was a year ago, just under 2,900 new wells drilled, and almost 30 million feet of hole drilled as well. Now, of course, the other news in Canada, and folks we got a lot of calls about, was what does it mean that President Biden's first act was to cancel the permit to allow building of the Keystone XL pipeline. And the takeaway really is that won't have much immediate effect on Canadian operators. They've oil production was down because of lower drilling activity last year, some shut-ins, and so the pipeline system isn't highly stressed for oil anyway at the moment. There's been increasing use of rail transport in order to get Canadian oil to markets. And so that's a satisfactory solution. It's a higher cost than what they'd like, but it can get oil to markets. And so the Keystone Pipeline isn't going to have an immediate effect. There's, of course, the ongoing interest on the part of the Canadian oil patch to find new export markets, not just be tied entirely to the U.S. for its oil and gas exports. And so a lot of hopes being pinned on gas export pipelines and new oil lines that lead to the West Coast so they can export into the Pacific Basin market. And all those are in place, but will take some time. The other interesting thing I point out to folks, about the Keystone Pipeline is it's like that old story about Sherlock Holmes and the dog that did not bark. So I think that was the book, The Adventure of the Silver Blaze. And so the dog that didn't bark with regard to the Keystone XL pipeline has always been the U.S. refining sector. And a lot of those barrels were headed for the U.S. market for refining. These are heavy oil, high sulfur for the most part. And so refining sector here in the U.S. was ideally suited to process those barrels. And you would think, well, my goodness gracious, by not building the pipeline, that's really going to hurt those refineries here in the U.S. They would certainly be ones to raise a fuss about not building the pipeline, the Keystone Pipeline. But we've not heard much about them. And I think the reason for that is that, again, there's rail transport available, right? And that rail transport means that the price of heavy oil in Canada as traditionally would be lower than what it might be otherwise if those barrels were delivered by pipeline. So the U.S. Refining sector tends to benefit by the lack of a pipeline because it means that some of its input costs are very, very low. And so that was the dog that did not bark and demand that pipelines from Canada get built anytime over the last several years. So, but again, from the standpoint of the Canadian sector, they really do need better access and more access to foreign markets apart from the U.S. so that they've got a place to sell their oil going forward. Now, the Canadian market too then is, what does that mean in terms of wells drilled? Well, oil well count is the weaker part, or the rig count part up in Canada. We think that this year we'll see the rig count numbers for oil wells down about 9%. The gas well side is held up fairly steady. Gas drilling activity had increased slightly last year and looks to increase slightly again come 2021. The other interesting thing to keep an eye on in Canada is Canada's federal government has decided to increase its carbon tax, which is currently $30 per ton of greenhouse gas emission, and increase that to $170 per ton of greenhouse gas emission by the year 2030. So those numbers are going to go up by a factor of almost 5 over the next decade if what gets proposed gets instituted. What we think that means is that adds that cost at $170 a ton ends up being about $3.50 per barrel of carbon tax per barrel of oil produced. So it's a not insubstantial figure when you think about what the profitability of oil companies tends to be. Again, those operating income figures that we were talking about earlier that oil companies here in the U.S. Enjoyed would suggest that their operating income numbers are typically 8 to 9% of revenue, and a carbon tax for any operator is going to materially impact what their profit figures might look like, because I think that's who would be the ones paying the tax rather than the ultimate customer for the oil or gas, but rather the operator who is producing it. Done with North America. I want to spend some time talking about the international market, because while most of our revisions in terms of drilling activity have taken place in the U.S., we haven't changed Canada that much. We've also bumped up our numbers with regard to international, but not nearly to the extent that what we have here for the U.S. So now we're looking at what we think will be an average rig count internationally of about 680 rigs in 2021. That's a number that's down from about the 755 rigs. Good morning. Last year averaged. But again, as you can see, as time goes by, from Q4 of last year through the Q4 of 2021, rig count goes from about 600 to around 720. So it's about a 20% increase over the course of this year in the international sector. Not every country gets to participate. Not every region even participates in the same amount. But broadly speaking, the international sector is looking better and will continue to improve from this point forward. We've talked about some of the things that particularly Western operators working in the international market are facing, and one of the new things that emerged starting about a month ago now was that the folks at S&P Standard & Poor's have put the oil sector on credit watch, basically, and have downgraded the credit ratings of several majors already. I think Exxon, Chevron, ConocoPhillips were all in that group. Shell might be as well, if I remember correctly. And there's another half dozen or so that are also have been put on notice that they may have their credit ratings reduced. Now, these are typically reductions of one level or so. So it's not like they're suddenly overnight, deadbeats. But the effect anyway would be to raise the borrowing costs of these companies going forward, and that's again a challenging position that they're in, because it's just harder to get access to credit markets. And S&P would point out that the issue of energy transmission, will there be climate policies adopted that actually then cap the potential growth in oil and gas demand, begin to shrink it over time? All of that begins to raise questions around the capital structure of companies and so forth. And so this is the reason why they've begun to do that. But that just adds one more challenge to many of the large companies that work in this particular market. In addition, part of while drilling activity is recovering in the international sector, we don't think that the rate of recovery is going to get back to the point where it was back in 2019. And again, that's in part because for so many of the large companies that are the ones working internationally, they're directing an increasing share of their capital spending to non-oil and gas energy development. So wind, solar, you name it, as well as more dollars toward carbon reduction programs. So all of that is sort of shrinking the size of the bucket that is available for drilling activity in the international sector. And so while things have begun to improve, they're not going to snap back. We don't see them going back to the levels that they were back even 18 months ago. So what does that mean in terms of rig or new wells drilled? So we think the numbers add up to around 6,750 new wells in 2021 and a little over 53 million feet of hole this year as well, numbers that are down 5 to 6% from what they were in total last year. As I had said before about the U.S. market, I think a lot of the exploration and development activity that we're going to see this year and going forward in the international sector is going to be what we think of as infrastructure led. So what's near existing infrastructure, platforms, pipelines, you name it, so that helps minimize the cost that is needed to bring a field on. And so that's just, I think, an element of where the activity is going to take place as things begin to improve. Will be informed by this question of what other assets are nearby and what might we be able to do to make use of them. So when we look at it region by region, there's different flavors, emphasis in each one. Central and South America is a market that we think is going to recover pretty sharply this year. So much of the rig count in the second and third quarters of last year was really negatively impacted by restrictions that didn't allow rigs to work. It was considered a work site that workers could not get to. It was like indoor dining. So that suppressed rig count in the middle part of last year. Thankfully, many of those kind of restrictions have come off, and so we've begun to see a recovery in activity, and that's contributing to the larger percentage growth that we think the South America will enjoy in 2021. So up about 20% or more in terms of rigs, wells, and footage drilled. Individual stories are interesting, of course, by country basis. Argentina is one, of course, where much of the activity has been linked in recent years to the exploration and development in the Vaca Muerta. The government there had been supporting both oil and gas prices. It kind of relaxed those support numbers, and as a result, that's really impacted the level of drilling going on there. But recently there's been a revival of a proposal to build a new gas pipeline from the Vaca Muerta to Brazil as an export market, and that may at some point lead to a recovery in activity in that particular sector. Ecopetrol down in Colombia has plans to increase its capital spending this year. Guyana, of course, is perhaps a highlight sector because of the exploration field development work that Exxon and Hess are turning in there with its their Starbrook field. They've recently approved the development of the phase 3 of that project, and so work continues to expand there and will remain strong going forward. What's interesting so this is the third phase of development that Exxon's looking at in the Guyana market. The first phase was producing 120,000 barrels a day, and I think the cost was a little over $4 billion to get that developed. Second phase was going to produce 220,000 barrels a day, or will produce 220,000 barrels a day when it comes on stream, and that project element was going to cost $6 billion. So now you're looking at $35,000 to $40,000, I guess, per daily barrel of production that it's adding. The third phase of development, again, will produce around 220,000 barrels a day when it comes on stream, but its cost is now, I think, around $9 billion is what has been reported. So now we're looking at costs of on the order of $40,000 to $45,000 per daily barrel of production for the development of those fields. So that's pretty typical, I think, of what we see in the international, particularly deep water areas. And but something to keep in mind, because those are clearly big numbers, and both in terms of the daily cost per daily barrel, as well as just the total figures: $4 billion, $6 billion, $9 billion, all getting it done. So those are it requires a lot of deep pockets. That very deep pockets. I give a lot of pockets or a lot of very deep pockets, maybe both. Europe's a market that is not changing much. In fact, our year-over-year rig count is absolutely flat at 58 rigs. 600 wells and about 6.5 million feet of hole drilled. Not much going on there. We've seen a little bit. Norway will enjoy a bit more exploration activity this year, and probably an uptick in field development project, at least announcements, work that will take place at some point in the future. But those numbers are beginning to improve there for Norway because of tax legislation that the country passed middle of last year that sort of helps support the sector. In the UK, we haven't seen nearly that much good news. Exploration will be, and appraisal work will be up slightly, but it was almost rock bottom last year, so not much of an improvement that would be noticed. And operators in the UK sector, anyway, are under increasing pressure. I think there's now an absolute requirement to reduce their Scope 1 greenhouse gas emissions. So those are things like methane leaks and so forth that they have direct control over. Norway, while it gives with one hand in terms of tax credits for field development, proposes to take away with the other hand by instituting a $200 per ton tax on carbon by 2030. So obviously putting pressure on operators to reduce their carbon footprint, or else pay a fairly significant fine. And then the other point we raised is about Denmark. So Denmark being the largest oil producer in the European Union, now with the Brexit behind us. Denmark produces about 100,000 barrels a day. It wants to end oil production by 2050. So it's got some work to do there. If Denmark was in the United States, it would be the number 9 largest oil producing state. I think it would rank either just ahead or just behind Louisiana at this point. Not the Gulf of Mexico part of Louisiana, but the onshore piece of Louisiana would be sort of neck and neck with oil production with Denmark. So it's this is sort of the state of play with regard to the European market. Africa is again one that I think is yet to begin to see much of a recovery. As we've said before, Africa is a market that is heavily dependent upon exploration, and in a time when demand has fallen, when prospects for demand growth are questioned, it's hard to get much excitement and attract many dollars into the exploration side of things. So that's really had an impact on exploration in Africa for several years now. We could really draw this chart back to, say, 2014, and we'd see activity just kind of continually moving down and to the right over time. Our 2021 forecast is to see an average of 86 active rigs in the African market, just under 700 wells drilled, and about 5.7 million feet of hole as well. So it's a market that a lot of operators are beginning to question. It's got several headwinds. Like I said, the macro environment for oil and gas demand is one that causes problems. Certainly some governments in that area have been very slow to react with regard to sustaining fiscal incentives for operators. So we mentioned a moment ago how Norway had redone its tax program so as to encourage activity in that country this year and next. We haven't seen those same kind of changes made in many countries in Africa, and that contributes to the sluggish nature of activity there. Nigeria, of course, being the largest producer there, has been one that has been talking about revising its petroleum legislation for at least a decade, I think. Right now, the NNPC, Nigerian National Petroleum Company, is in the process of revising commercial terms with operators in the country, and apparently these operators will have the choice of whether they want to operate under the revised commercial terms that NNPC is conducting, or whether they want to operate under the terms of a potential new petroleum legislation that might get passed in May. So we'll see how that turns out. But again, it just points to one of the issues that is a real challenge for operators in that particular area right now. And there are some programs going forward, but it's very operator specific and field dependent. The Middle East is a market, of course, that just collapsed activity in the second half of last year after having turned in multiple years of very steady activity, whether oil prices rose or fell. Mideast rig count was little changed, but that all changed in the second half of last year, where operators began to really restrict spending in order to conserve cash, and rig count fell, even though many of the contractors with those rigs were told that the decline was only temporary, and they began to see rigs put back to work in 2021. Well, I think we've begun to see that, but at this point it's hard to see a sharp rebound in activity in that particular market. So we see, on average, the numbers suggest us that we'll see around 253 active rigs, down about 20% from last year's average, 2,300 wells, and about 19 million feet of hole drilled. What's interesting is that one of the countries that continues to be pretty bullish about its upstream activity is Qatar. It's got the big North Field, and it wants to increase its LNG export capacity from that field substantially. Right now, Qatar is, I think, number 2 in the LNG export market behind Australia, and it wants to regain the number 1 slot. So it wants to increase its capacity to produce LNG from, I think it was 77 million tons per year to a number that's now about 125 million tons per year. So it's a massive program. Multi-billion dollars. I think phase 1 is $35 billion or thereabouts, but it's moving forward on those actions. And in response, some of the other gas field development projects that were to take place in other countries like Abu Dhabi and even in Saudi Arabia are beginning to be shelved or certainly delayed. There's certainly an impact, because why go to the expense of developing fields at a much higher cost than what the Qataris have, when maybe I just get my gas from them? So how this is exactly all going to play out is still a work in progress, but just a month ago or so, Saudi Aramco announced that one of its big unconventional gas development projects, Jabura, which was supposedly a sacred cow, it was not going to be touched by any of the cutbacks in capex, was indefinitely delayed. And I think this is just a fact associated with some of the big projects, or the big projects that is happening on the LNG side in Qatar. And then we also look at the Asia Pacific market. So here is one that has begun to recover. It was sort of a shallower decline from last year than many regions experienced, but again, not a rapid recovery. We still see something on the order of about 152 rigs working on average in this area in 2021. Down about 11% from a year ago, 1,500 wells, almost 9 million feet of hole drilled. So, a market that's in the early stages of getting better, but a slow recovery as best we can tell at this point. A lot of the work here is gas field exploration and development driven. And it's kind of interesting if you look at the LNG market. So a lot of these projects here are for export of LNG. LNG prices just soared this past winter. It was very cold in the northern hemisphere in Europe and in China. And so prices for LNG went through the roof. It was hard to get cargoes. You would think that would, light a fire under gas development projects, but that's not so much been the case, at least not yet. And so we're still sort of waiting for the effect of a more robust LNG market to work its way into development projects in this area. And in the meantime, there are a couple of markets, in particular Myanmar, because of the military coup from a couple months ago now. We've seen or heard other governments talk about putting sanctions on the country because of that coup, and any sanctions would probably impact the plans by operators in that country to develop fields and build pipelines and things like that. So there could be some casualties in the upstream sector because of the government actions in the market in Myanmar, the old Burma to those of us who remember our World War II days, I guess. Finally, we talk a little bit about China, Russia, and Central Asia, markets that are fairly opaque as best we can tell. China and Russia both will see very little change this year from last. Last year was not quite the collapse in activity that we had at one point thought was going to take place in those markets. They both ended up holding up fairly well, but we can't say much about things improving from this point in those areas in 2021. China, interestingly enough, has talked about being carbon neutral by 2060 on its part. So when it does the numbers, it suggests that China's use of oil is going to peak in 2025. Since China is the second largest consumer of oil around the world, this is materially important to the global oil market, and is again one of the reasons that S&P outfits like S&P and oil companies themselves, have to think about what the long-term condition the market's going to be and how they want to play it in terms of field investment and so forth. So, but again, carbon neutral by 2006, which means that, of course, the three big state-owned oil companies, CNPC, Sinopec, and China Offshore, are directing a larger percentage of their capital spending, just like the Western majors, into non-oil and gas or non-renewable type projects and gas, so solar, wind, hydrogen, and natural gas. Russia, we don't hear so much of an emphasis on renewables from the government or operators up there. Rosneft is a favored company, favored by the government anyway. It's received some tax credits for work it's doing in West Siberia and field development it's doing in East Siberia. So tax credits play a big role in terms of the new development dollars in the Russian market. And so work will be dependent upon government support, I think, and continue to be dependent upon government support in that particular area. Central Asia, a collection of countries including Azerbaijan, Uzbekistan, Turkmenistan, Kazakhstan, Ukraine, and so forth, all have saw a big impact on COVID last year in terms of their upstream work. As best we can tell, a lot of those countries are on the end of a supply chain that got greatly impacted by COVID and pandemic-related shutdowns. And so that had a knock-on effect in terms of field development work and so forth, as well as just the issue of health and safety of workers in those countries. And so that's still sort of playing out in many of the countries in Central Asia. And so we think activity will continue to slide a little bit there, as best we can tell, in 2021. But some of the Western companies are beginning to recover. So we've seen announcements by BP and Total about picking back up what they had postponed in Azerbaijan, and even in a country like Uzbekistan, we're seeing some notifications that there'll be some improvements going forward. So it's a story that suggests that there'll be a recovery in that particular market, but it will take some time, and in the meantime, it will be kind of a disappointing year for many of these places. That's the end of my slides, and so we'll go to the Q&A part of the session next. But just in summary, I want to say that the recovery has begun, both in North America and abroad, but the recovery we do not think will take us back to the levels that we were seeing as an industry back in 2019. So it's going to be better, but it doesn't get to those kind of levels, which means that asset utilization will continue to be a challenge for many service firms and pricing associated with that. I think the big issue for operators we'll hear more and more discussion about as time goes by, as they put more money into renewables, solar, wind, and so forth. The question will be, will these alternative investments generate as much cash and profits as their oil and gas operations? And I think that's going to be a fascinating question to see how it plays out, because there may be efforts to disaggregate, to spin off groups, renewable groups, just to make it easier for investors to understand what kind of returns they can expect from investments being taken in non-oil and gas areas. Again, nothing that probably gets resolved in 2021, but maybe the discussion begins this year and we'll begin to get some insight as to where that might lead us all in 2022 and beyond. So with that, I will stand down and make myself ready for any questions that folks have. I'm looking forward to this part of the discussion. Thank you very much.
Well, welcome back. We are live again, and I got to tell you, it was like watching I Love Lucy, without Lucy,
There you go. Right.
but with Ricky.
Yeah.
So we have some questions, and I think you've got the first one.
Sure. So let's just jump right on in. So the headlines today are that Saudi Arabia, in holding production off the market, is basic and thus pushing oil prices higher, is basically counting on U.S. oil companies to stay disciplined with their capital spending. Okay?
Huge assumption.
Huge assumption there, and that's the question. Then is, what would be the signal that U.S. operators are not being disciplined with their capital spending, right?
Because they have this big external event going on, which
Yes.
is the banks won't loan them any more money than they can borrow as if oil prices were $42 a
Something
barrel.
like that. Yeah. So I'm thinking about that, and really the question is, like, what would be the rig count number that would tell us that, hey, the shackles are off, we're back to our old practices. And I'm thinking that, of course, that's not going to happen tomorrow, but I think if we get to a rig count of, say, 600 by the end of this year, that would be a pretty clear signal that capital spending, the screws are being loosened, and we're going back, maybe not to the worst of the practices, but certainly things are loosening up there on the spend side.
So is the 600?
Because again, we're at 400 rigs today,
Got
so
it.
that would be a material increase.
So we've grown by 50%.
Yeah.
So that would mean that it's not necessarily just the level 600, but the pace at which we got to 600.
That's right. Yeah, because again, our forecast would say that maybe by the end of 2022, that we're to 600 rigs or more. So we'll be getting there eventually, but I think if we get there over the next 2 to 3 quarters, that would be a pretty strong signal that capital discipline is removed, that we would expect to see oil production in the U.S. begin to grow fairly rapidly, and now that calls into question whether oil prices can stay, $60, $70 a barrel. So good question, but I think that gives us some sense of what to look for.
It leads to one of the questions we got in the chat box, which was about Permian upstream service company capacity.
Yes.
And at what point do you see pricing power reverting back into the hands of the service company and away from the current situation, which is an oil company can call up any number of service companies and get a crew out for a pretty good price.
Yeah.
So at what point does that power switch over to the service companies? And it's not right now, except there are certain categories where pricing didn't really decline, like land contract drillers.
Right. Yeah, it's not. It got a little softer, but not much softer. Yeah. So again, when you think about the service sector, you have to think of both on the labor side and on the equipment side, right? And so, as you've always pointed out, labor is 100% utilized.
We are always at 100% utilization of people. Always.
Yes, right. And so we're that way today, even with a low rig count. So what we're really talking about in terms of low asset utilization is the equipment side of things. And so long as service firms don't have to spend much money to reactivate the units, if they've been maintained fairly well, they don't have a big upfront cost to bring them back into working condition, so long as they don't have to make those kind of spending, then I don't know that we would see a lot of movement on the pricing side for the cost of getting for their services. But once we do begin to see service firms have to lay out significant bucks to bring a frac spread back into that's been parked on the over there by the fence, but now it's catching jobs again, that might cost some money to repair some pumps or what have you. That's where then I think the service firms go back to the operators and say, listen, we've got to have higher rates because we've got these working capital expenses that we have to cover before we can even begin to catch your jobs.
Let's put a metric to it. If there were, in big round numbers, to the nearest 100, 400 frac spreads out there across the U.S., across North America.
Okay.
And those were working at the end of 2019.
Okay, 400. Okay.
Or middle of 2019.
Right.
And if if you're on your way to 200 working frac spreads these days,
Today,
as you approach, later on in the year,
Yeah.
you're not to that point yet where you're having to spend a bunch of money to get a frac spread back active. I'm going to say that you can get to 250 frac spreads working, and you're probably still taking a warm, stacked, pretty good shape piece of equipment,
Right.
rolling it out.
Yep.
But in the meantime, you've seen the 400 available frac spreads
Yeah.
drop to 350.
Right. Yep.
So once you get to 250, now you're in that zip code that says, I got to do something about, I got to call the transmission guy. I need to get a power end worked on.
Right.
I need more than just a standard
Yeah.
overhead done on my diesel engine. I've got to do something.
Yeah. So now we're looking at perhaps sometime in 2022. I don't know if the first half of the year, but maybe the second half of the year, we began to hear those kind of discussions, I think. Yeah.
Now, in a typical, we've tracked the price of things in the oil field for 13 years.
Yeah. Since 08. Yep.
Long time. And what we've normally seen is whenever activity begins to rise, there's a delay,
Right.
and then the price in the field begins to rise.
Yes.
I think of that as 6 to 9 months after it starts to rise. But this dip was so low
Yeah. Right. Yeah.
that maybe it takes a while longer.
Right. And so you began to say, okay, the Q4 of last year was when we, began to come back off the bottom. So we've got, a little bit of runway ahead of us before, again, those gaps between capacity and utilization or activity narrows enough that we began to see pricing return to the service company side of the table.
So 2021 is not the year that oil field service costs begin to rise across the board.
Right.
But next year,
Yeah,
pay attention.
I think we're looking at it. Yep. Okay.
There was a great question about, you've seen the shedding off of service companies. You've seen the rod lift businesses being sold to private equity, of
Right.
all things, by Schlumberger and Baker Hughes. And the question is, why would Schlumberger and Baker be doing things like that? But when you look at what the shareholders and the investors of Schlumberger and Baker are demanding those companies do, they demand that they're digital. They're demanding that they are approaching carbon neutral. But the other thing, and the biggest thing of all, is they're demanding that they are not U.S. shale focused. And so look what Schlumberger already did. They sold frac. They sold they got out of coiled tubing, and they got rid of rod lift. A huge focus on U.S. land. So get out of that. Same thing on the Baker side. Got out of frac and cement by the whole BJ thing a few years ago already, and they got out of rod lift.
Yeah, so I think that says, again, two things come to my mind. One is, what are the growth prospects for those markets? And so, if they think there's better opportunities for faster growing markets abroad, then North America doesn't become quite as much of a focus. But I think the other thing that's important is, how much competition would any of these companies be looking at in North America relative to the level of competition that they would face outside of North America?
I would far rather be a directional driller internationally than a directional driller domestically, because there's 100 in the U.S. and there's 2.
Right. Yeah. The number of potential substitutes is much higher in the U.S. and Canada than it would be abroad. So just competing is a bigger challenge there. Yeah. So.
There's a question about Argentina.
Right. The outlook for the Vaca Muerta over the next 12 to 24 months. So, drilling activity in Argentina got hit pretty hard last year. I think rig count averaged 20 for the year, something like that. And we have activity today stands at 35, and we have it averaging 40 for the year. So we see almost a doubling year over year for the Vaca Muerta. Part of that's just a little bit of a recovery in the economy, because we don't see the government going back to the strong price support that it had offered, which was really driving drilling in the Vaca Muerta back 2-3 years ago. 2-3 years ago, rig count was 60, 70 in Argentina, and but there's a lot of support for prices on the part of the government. Well, they're not in position to do that. So it's going to depend upon the market providing a high enough price to incentivize operators. And so that's going to, bring buys back in. But so a decent recovery, good percentage kind of recovery this year. And then going forward, I think there's some growth, 10% a year kind of stuff that it would be my guess at this stage. Yeah, absent recovery in the government price support program.
And that could happen, but that's not the way to bet.
I don't think so right now, anyway. Yeah.
Charlie, have we had any others come in since we launched our discussion? So I think we're about there.
Yeah.
We really appreciate our client. Oh, here's one.
Okay. The split in the U.S. rig activity. The question was, what's the split between majors, NOCs, national oil companies, and independents? Well, we don't really have national oil companies in a big way in the U.S., not as operators. I mean, for example, Ecopetrol in Colombia has an investment or has had an investment in Permian operations, but I don't think they're the operator of record. So the 35 or so most active drillers in the U.S., again, to collectively drill about 45% of the wells. The majors, the Exxons, the Chevrons, the integrateds account for 5 to 6% of the total, and then the big shale guys like ConocoPhillips, EOG, Devon, and so forth, they're another 35 to 40%. And then you have the other 2,000 who drill the rest, the 2,000 operators who drill the 55% of the wells in the United States. So you have a lot of really small operators out there, but those are the rough numbers as I recall.
For the time being, that's what we're going to face, because
Yeah.
international oil companies are acting like international at this point, but there is an ebb and flow that always occurs. And so for the time being, this is the domain of the independent oil company,
here,
and
more.
who are always very focused on just being an oil and gas producer.
Yes, right, absolutely.
So anyway, we thank our subscribers. If you are a subscriber, you've already gotten our written report and the details associated with it. There's data files that come with this service. There's access to my brother. He'll have you over at the house. You've got a spare room.
Come on over.
Yeah, that's the premium subscription. And but we're always glad that people stick with us over the years. So thank you very much for being part of our Drilling and Production Outlook.
Look forward to meeting again in June. So thank you much.